Welcome to Consumer Times, your trusted source for consumer awareness and updates. Today, we will talk about an important topic that is, are banks consumer friendly in India? Exploring challenges faced by consumers. India's banking system has evolved tremendously over the years, transitioning from traditional banking methods to tech-driven services. With advancements such as online banking, UPI, and mobile apps, consumers now enjoy unprecedented convenience. However, alongside this modernization, concerns about whether banks truly prioritize consumer needs and fairness have emerged. From hefty penalties for minor lapses to sudden account blockages due to KYC non-compliance, many consumers feel that banks operate more as rigid institutions than as service-oriented organizations. Before going ahead and further discuss, please comment, like, share and do not forget to subscribe and press bell icon to motivate us. There is rise of penalty-driven banking. One of the most common grievances among consumers is the imposition of penalties for a wide range of activities. Banks charge fees for insufficient balances, delays in ME payments, and even non-maintenance of minimum balances. While these measures are often justified as necessary to ensure financial discipline, the rigidity with which they are applied can feel punitive rather than corrective. The major is non-maintenance of minimum balance. Many banks mandate a minimum balance in savings accounts, failing which customers are charged a penalty. For low-income groups, maintaining a minimum balance can be a challenge, especially during financial emergencies. The penalty not only erodes the consumer's hard-earned savings but also creates a sense of distrust in the banking system. Despite the introduction of zero-balance accounts under the Pradhan Mantri Jan Dhan Yojana (PMJDY), many consumers still find themselves at the mercy of penalty-driven policies, ME and loan repayment penalties. While it's understandable that banks need to ensure timely repayment of loans, the penalties for delays can often be disproportionate. Consumers who may have missed an ME due to unforeseen circumstances like medical emergencies or job losses are further burdened with additional charges. Such practices raise questions about whether banks consider the financial realities of their customers. Blocking of accounts, a major concern. One of the most controversial practices in recent years has been the blocking of accounts without prior notice. In the name of compliance with Know Your Customer (KYC) regulations, banks often freeze accounts, leaving consumers in distress. The importance of KYC compliance. KYC norms are essential to prevent financial fraud, money laundering, and terrorism financing. However, the manner in which these norms are enforced can sometimes appear consumer unfriendly. Customers have reported instances where their accounts were blocked despite having submitted the necessary documents. In some cases, they were unaware of any issues until they tried to make a transaction. A significant problem is the lack of timely communication from banks. Notifications about pending KYC updates are often buried in fine print or sent through SMS and emails that many customers miss. Instead of giving ample time and clear instructions to rectify the issue, banks take drastic action by freezing accounts, causing inconvenience and embarrassment. Blocked accounts can have severe consequences. From missing important payments to being unable to withdraw money for emergencies, the ripple effects of such actions can be far-reaching. This practice disproportionately affects senior citizens and those in rural areas, who may not be well versed with digital banking or documentation requirements. For a system to be consumer-friendly, an effective grievance redressal mechanism is crucial. Unfortunately, many consumers feel that banks in India lack adequate support systems to address their complaints. When customers face issues, the first step is usually to contact the bank's customer care. However, long waiting times, repetitive IVR menus, and insufficient resolution often leave consumers frustrated. In cases where the problem isn't resolved at the branch level, escalating the issue to higher authorities or the banking ombudsman can be time-consuming and complex. Consumers often complain about the lack of transparency in how penalties are calculated or why certain actions, like account blocking, were taken. Without clear communication, customers are left to navigate a confusing maze of policies and regulations. This lack of accountability undermines trust in the banking system. The Reserve Bank of India, RBI, serves as the regulator for banks in India, laying down guidelines to protect consumer interests. However, despite these regulations, implementation at the ground level remains inconsistent. The RBI has issued guidelines to ensure that penalties are reasonable and not exploitative. For instance, it has mandated that banks should charge penalties proportionate to the shortfall in minimum balance, rather than a flat fee. However, not all banks adhere to these directives uniformly, leading to varied consumer experiences. Consumer awareness. A significant gap exists in consumer awareness about their rights and the avenues available for redressal. Many customers are unaware that they can approach the banking ombudsman or escalate complaints through the RBI's complaint management system, CMS. How can banks become more consumer friendly? While the challenges are significant, there are several steps banks can take to improve their relationship with consumers. Banks need to prioritize clear and proactive communication. Whether it's about KYC updates, penalty charges, or changes in terms and conditions, customers should be informed well in advance through multiple channels. To minimize the risk of account blockages, banks should simplify KYC processes, especially for vulnerable groups like senior citizens and rural customers. Extending deadlines and offering in-person assistance can go a long way in building trust. Banks should revisit their penalty structures to ensure they are fair and proportional. For instance, instead of imposing flat fees, penalties could be tiered based on the extent of non-compliance. An efficient grievance redressal system is the cornerstone of consumer trust. Banks should invest in well-trained customer service teams and digital platforms that allow for quick resolution of complaints. Empowering consumers with knowledge about their rights and responsibilities can bridge the gap between banks and their customers. Financial literacy campaigns, especially in rural areas, can help consumers understand banking regulations and avoid penalties. While Indian banks have made significant strides in enhancing accessibility and convenience, there is still a long way to go in becoming truly consumer-friendly. Penalty-driven policies and rigid compliance measures often alienate consumers rather than fostering trust. By prioritizing transparency, fairness, and customer-centric practices, banks can build a system that not only complies with regulations but also values the needs and experiences of their customers. For consumers, staying informed about their rights and maintaining open communication with their banks can help mitigate some of these challenges. Ultimately, a collaborative effort between regulatory bodies, banks, and consumers is essential to create a more inclusive and equitable banking ecosystem in India. If you found this information valuable, don't forget to like, share, and subscribe to Consumer Times for more updates on consumer awareness and business tips. Thanks a lot for watching. See you in our next video. Stay safe, healthy, and stay aware.